What's up guys, my name is Kieran and you're very welcome to the channel. In this video I want to talk about my gold investing strategy. I want to talk about why I'm buying gold. I want to explain what I think the price is going to do over the next 4 to 5 years, and I want to explain when I intend to sell my gold position as well. Very recently I did a video talking about why I think silver is going to go to $50, and in that video I talked a lot about gold as well, and specifically I talked about the increase in the monetary supply and how that affects precious metal prices. But in this video I want to dig deeper into just gold. I want to explain 2 reasons why I think now is the perfect time to be investing in gold. I want to explain what I think is going to happen to the price over the next 4 to 5 years, and as I said, I want to get into a bit of detail around when I intend on selling my gold position. So if that's something you're interested in hearing about, if you're excited about this video, then please smash the like button, and if you haven't yet, subscribe to the channel. So why am I buying gold? Well, there's actually a lot of reasons why I'm investing in gold, but there's 2 big reasons why I'm doing it, and I want to discuss them here today. The first reason, guys, is that smart money is buying gold. Ray Dalio, for instance, who is a really successful investor and the owner of Bridgewater, has been buying gold very heavily, and this came out in their Q2 filings. Now, Ray has always been an advocate of gold, and he prescribes this thing called the all-weather portfolio that's supposed to essentially give a good return no matter what the economic outlook is. So whether we have inflation, deflation, whether we have low growth or high growth, the all-weather portfolio is supposed to perform, okay, in all types of scenarios. And typically Ray has prescribed allocating about 5% of your portfolio to gold as part of his all-weather strategy. However, in the Q2 filings we can see that Bridgewater, Ray Dalio's fund, has deviated massively from Ray's prescribed 5% allocation. And in fact, in Q2 we know that Bridgewater have poured a massive $400 million into gold-backed ETFs, and this has massively increased Bridgewater's positioning in gold. In Q2, Bridgewater raised its position in SDPR Gold Trust from 600 million to over 900 million. And as well as this, it raised its position in iShares Gold Trust from 176 million to 268 million. Now, to put this in perspective, at the end of Q2, Bridgewater's total assets under management was about 5.9 billion. And of this 5.9 billion, Bridgewater now has 20% assigned to gold. This is massive news, and it shows a huge shift in Ray Dalio and Bridgewater's strategy when it comes to investing. On top of this then, we've all heard the news that Warren Buffett has bought a stake in Barrick Gold. Berkshire Hathaway has bought over 20 million shares for a total value of about $564 million. Now, this is really meaningful because historically, as you probably know, Buffett has been very against buying gold. Now, while this isn't gold, it is a miner and it does generate a cash flow, which Buffett is of course an advocate of. It does show a real change in Buffett's philosophy. Clearly, Warren or the people at Berkshire expect the price of gold to increase over the near term. At the end of the day, Berkshire invests for cash flows, and if the price of gold decreases, well then the cash flows that Barrick Gold generates are going to decrease also. Whereas if the price of gold increases, the cash flows from Barrick Gold will of course increase alongside of the price of gold. So clearly Warren Buffett is bullish on the price of gold. On top of this then, guys, Berkshire sold out of most of its bank positions. Now, while neither of these pieces of news are monumental on their own, when you put them together, okay, it tells a real story. In my opinion, Berkshire selling its bank stocks and buying a gold miner stock really conveys what they think the next couple of years has in store. As always, guys, when you're investing, you need to be mindful of what the smart money is doing, because people like Warren Buffett and Ray Dalio, they have connections and insights and information that us common folk could only ever dream of, okay? Don't for a second think that these big positions and these big bets aren't being made with insider knowledge and information. I mean, Berkshire are a massive, or at least were a massive shareholder in these banks, so they're privy to information on the inside. They also have massive connections outside of the banks, giving them huge amount of information on what's happening in the macro environment, what's happening with the Fed, the government, and the economy in general. So when these guys make a position in gold, when these guys make a strategic shift in how they allocate their capital, you better pay attention. So guys, that's the first reason I'm buying gold. So the second reason I'm going to be buying gold, guys, is because of inflation. So on Wednesday, the Fed chairman, Mr. Jerome Powell, took to a virtual stage to inform us of a change in Fed's policy. Now, as usual, Jerome used lots of big words and convoluted phrases to try and explain to us common folk about this shift in Fed strategy. And he made it sound very reasonable and logical, and it all kind of went over most people's heads. Well, it clearly went over the media's head anyway, because nobody was talking about really what this means. But don't worry, because if you can't decipher Fed speak, I've found this meme that clearly articulates what Jerome said. Now, what does that actually mean? Well, basically it means that the Fed is going to do everything in its power to increase its measure of inflation, which is called the Consumer Price Index, to above 2%. Now, what does the Fed have in its power to do this? Well, it has a printing press and it has the ability to lower rates, or at least keep them low. Now, what does this 2% actually mean? It's 2% as measured using the CPI, the Consumer Price Index. And this is a measure that the Fed uses for inflation. And it's supposed to measure the cost of our standard of living. So it's supposed to take a fixed basket of goods and services and measure the price increase of those over time. And the idea was originally that the Fed was supposed to maintain prices so that they don't increase at a rate greater than 2%. So originally, when this actually came about, if we had 1% inflation, the Fed was considered to have done their job. But now that's shifted in such that now the Fed is saying that they have to maintain inflation at 2%. Well, that was actually never the original thought behind this. It was that they were supposed to keep it below 2% so that people could maintain their standard of living. What is inflation really? Okay, it's the devaluation of our currency. It's nothing really to do with prices. Prices will go up and down depending on what's happening in the economy. In its truest form, it's a devaluation of our currency. The CPI is not a good measure of that. But to make things worse, even when it comes to the CPI itself, let me show you a website called shadowstats.com to explain how they've actually changed this measure over time so that it basically under-measures inflation. So this website, shadowstats.com, is by a guy called John Williams. And basically what he's done here is he's measured CPI according to the way they used to measure it back in the 1980s, before they changed it with all this stuff called hedonic quality adjustments and substitution. Like basically in the original fixed basket of goods and services, you might have had steak or some sort of meat product. And then in the 90s, they brought in this thing called substitution, where they could substitute that for a lower cost alternative like Spam. And the thought process here was, well, you can just eat Spam instead of steak, and that's basically the same as maintaining your standard of living. But that's horseshit. What we can see here is since the 1980s, the CPI measure of the Fed, which is in red, has kind of oscillated from around 5%, down to 1-2%. It went negative at the crash in 2008, and then it's been kind of oscillating around 2% or slightly below. But what we can actually see here is, based on Shadow Stats' alternative CPI, which is based on how they calculated in the 1980s, that real inflation as measured per the 1980 standard has deviated massively from the Fed's measure of inflation. And as I said, this is because they brought in lots of weird convoluted things to artificially lower the rate. But in actual fact, real inflation, since 2010 we'll take it, has been nearer to about 10% as opposed to below 2%. So this is really important stuff, right? Because now when the Fed chairman Jerome Powell says that they're going to try and overshoot the 2% inflation target, we know that that really means that inflation is going to run upwards of above 10%. And I guarantee you, Warren Buffett knows this, Ray Dalio knows this, and everyone else in the smart money industry knows this. And what's this going to do? Well, it's going to inflate asset prices, it's going to drive up housing prices, it's going to drive up the stock market, and it's going to drive up precious metals. And everybody in the upper echelon of society who actually holds real assets are going to get richer. Meanwhile, everybody in the lower class of society who don't have assets and actually live paycheck to paycheck on fiat currency and save in fiat currency are going to get poorer. So this is, guys, in a nutshell, the second reason why I'm buying gold. Now, this whole inflation fiasco Dalio are being told has huge implications. I'm not going to get into it in detail here, but if you'd like to hear more about it, I can do a standalone video on it. Just let me know down below in the comments, okay? Okay, so now I want to talk about my investing strategy with gold. Because when you invest into anything, it's important to have a strategy. When do you intend on cashing out, and what do you expect to happen over the next 4 to 5 years? Now, this is the perfect time to say I'm not a forecaster and I'm certainly not a financial advisor. So this isn't any recommendation. This is just what I intend on doing. Always do your own research, your own due diligence before making any investment decisions. Also, at the end of this video, if you think I'm absolutely off the wall or you think I'm being really stupid in my decisions, let me know in the comments below. I'd love to hear your thoughts on this. But personally, okay, I'm expecting the price of gold to at least double over the next 4 to 5 years. However, I would not be surprised if it even tripled, because historically when gold has overshot its fair value, it's gone quite far in that direction before eventually topping out and returning back to earth. Now there's 3 real graphs or indicators that I'm going to be watching that I want to share with you now, and I'm going to talk you through my process in terms of how I know when I'm going to cash out on this. Okay guys, so there's 3 charts I want to go through with you today. The first one is the price of gold, okay, and I'm looking at this on macrotrends.net, and I'm looking at it on a non-inflation adjusted basis. And the reason I'm doing this is because if we inflation adjust it, the figures that are being used here are the CPI figures, which we know are absolute horseshit, so we're not going to use them. We're just going to look at it non-inflation adjusted. The second graph I want to look at here is the S&P 500 to gold ratio, again on macro trends, and this basically looks at the number of ounces of gold it would take to buy the S&P 500 on any given month. This is a really interesting chart that shows us so much data in one. The third graph then I want to look at is the price of gold against the stock market. So this one's actually looking at the historical percentage return for the Dow Jones Industrial Average against the return for gold over the last 100 years. And between these 3 charts, we can be in a really good position to know when to sell out of our gold position. The main chart I'll be looking at is this one, right? And let me explain how this one works. So basically we've got some really massive peaks and troughs in this chart. And it's during these peaks and troughs that we should have been either buying or selling gold. Let me explain by looking at this example here from the 1980s, when this graph hit an all-time low of 0.17, which basically means that the S&P 500 was dirt cheap in comparison to gold. So either gold was really high or the stock market was really low. Well, let's go and have a look and see what was happening there. So if we look at the 1980s, we can see, sure enough, that gold was in a huge bull market. So if you were looking at this graph here, you would have known that now would have been the time to sell gold because the S&P 500 was so cheap in comparison to it. In contrast then, if we look at this major peak here, an all-time high of above 5, we can say that either the stock market was really, really expensive or gold was really, really cheap. But either way, we know that this would be the time to be buying gold. So let's take a look and see what was happening in 2000. So lo and behold, we can see that the stock market was at an all-time high and that gold was in a serious bear market at the time. This was of course the dot-com bubble, and the stock market then crashed, and of course after this gold rallied massively all the way up to 2011 at a 439% gain. Okay, now let's fast forward to today, where we see we're kind of at 1.66, kind of in a median range, I would say. We're not too high, we're not too low, but what we can see is the general direction of this, and it looks like it's coming down. And based on the macro backdrop, based on the price of gold, and based on the S&P 500, and based on the stock market in general, I believe that it is going down, which means that gold is likely to get more expensive when measured against the stock market. So my outlook here is that this is going to drop down to somewhere around this region here, and that's when I would intend on selling. And there's 2 things that could happen to drive this down. Either the price of gold could spike, or else the stock market could crash. But either or is good for gold. Now the opposite of that would be if this graph trends up here, which means that the stock market rallies in comparison to gold, or else that the price of gold drops relative to the stock market. And I think those 2 scenarios are much less likely than the other ones that I just mentioned that will drive this graph down. But either way, it means that in my mind, gold is set to outpace the general market. It might not outpace individual stocks, but I think it will outpace the overall market. and I'll be watching this graph over the next 4 to 5 years, and my intention is to sell down around here. Now, if there's a significant shift in momentum and we start to see this graph rally upwards, I will of course reconsider my situation. In terms of the actual price of gold itself, I think it's very feasible to see this rally upwards of 3,000 to 4,000 over the next 4 to 5 years. Because as I just mentioned, the Fed is going to continue printing money and they're going to keep rates low. So what you're looking at here is gold denominated in the value of the dollar, and I expect the dollar to weaken. So therefore it's not inconceivable to imagine the price of gold shooting upwards of $4,000 to $5,000. If we look at this graph here, which as I said compares the returns of the stock market against the returns of gold, I can't imagine the stock market rallying higher, and if it does, I can't imagine gold not outpacing it, to be honest. But what I expect to happen really is that the stock market is going to either drop or go flat, and I expect the price of gold to come up, and I expect the two of them to converge together. I don't expect a divergence here. And all of this and these three graphs, as I said, they make me bullish on gold, and they make me more bullish on gold than the overall market. So guys, I hope that gave you some insight into why I'm buying gold, and it gives you a bit of insight into when I intend on selling, and it might help you make your decision in terms of when you will sell your positions if you're also invested in gold. Let me know in the comments below what you think of the three graphs that I showed you, what you think of my thinking in general, and if you think I'm on the right track. If you got value from this video, guys, don't forget to support the channel by giving me a like, and if you haven't yet, subscribe and hit the notification bell so you get notified of future videos. As always, thank you so much for watching. Have a smashing day, and we'll see you in the next one.